right, everyone. Welcome back. We are pleased to welcome David Morgan. He's the founder of themorganreport.com. He started investing in the stock market well before turning 18 years of age. Several years ago, he put his long study of the free market economies to work, researching the economy, stock market behavior, and precious metals, especially silver. Although very familiar with gold, Mr. Morgan delved into silver, and it needed more exposure, and it would be utilized increasingly as technology continued to demand more and more of the metal. He has followed the silver market daily for over 30 years, and much of the silver-investor.com site is devoted to education. David, thank you so much for being here. It's all yours, sir.
All right, Mark. Well, thank you, and thank you to the Money Show, Debbie, and all the people that are involved. I appreciate the invitation. So, Mark, before you leave, can you verify this is for AIs, correct?
It's for what? I'm sorry?
Accredited investors.
Oh, it is. Yes, that is correct.
Great. Yeah, I wanted to be sure. Okay, thank you. All right, everyone. My main function today is to be of maximum use to you, the investors, and I want questions as early as possible. I can stop the presentation nearly at any time and devote the half hour that we have together to answering the questions that are of import to you. So the title of this presentation is Where to Invest in 2022. And kind of the smart aleck answer is stay put. Now, what it means is you don't have to change a lot. And I will give you my thoughts on the general outline for the economy and what that means for the financial markets. And anyone that's paid attention to my work over the last few years or more will know that I have been a big advocate of the fact that there's very little correlation between the financial markets and the physical economy. And that's unfortunate because there's a signal given to most people that don't understand the bifurcation between what the financial markets and pundits talk about on the main financial channels and the main financial press about how well things are based on a number that keeps getting larger and larger versus the deterioration of the overall global economy. And really the more important aspects, meaning energy, for example, food as well. And then, of course, in the background, there is this war drum beating, maybe exaggerated, maybe not. Sometimes things that start off rather not that big a deal turn into a spark that ignites something very substantial. So I'm not going to address that topic unless I get asked a direct question. So my main specialty is where you would put maybe 20% of your wealth, and that would be into the resource sector. And the reason resources is because that's part of the economy that we can't do without. There's an expression I've given in many of my lectures about if it can't be grown, it has to be mined. So obviously, as I said a moment ago, everything that we get that's considered essential to human life, we call the economy, the essential parts are food and energy. The two things that the government of the United States took out of core inflation rate, which is non sequitur as far as I'm concerned. If you think about it, the two most important commodities for human anywhere on the planet is food and energy. Take those out of core inflation, that is core inflation. But those would be what I would define as core inflation. What's food and energy doing? That would be the two things that people need the most. So anyway, back on topic, when and how. So everything runs in cycles. And Mike Maloney, my friend from goldsilver.com, has done an excellent job, and a lot of money that he put out that he could have basically put into the business. He made this Hidden Secrets of Money series. And in one of the earlier presentations, he shows you the stock market and the gold market, and they're counter-cyclical. So if you were a perfect timer, you could be in the stock market for a decade or so, switch into gold, which would have been a great thing to do, let's say in like 2000, hold gold from 2000 to 2011, get out of gold in 2010 or 11, switch back in the stocks, go from 2010 to 2020 or 21-2, and then maybe switch back into gold. Are they exact 10-year cycles? No, I'm just giving you an outline you don't have to make a lot of moves. In other words, these cycles usually continue for several years. They're major trends. They have ups and downs, but big money is usually made by buy and hold. Not always. There are traders that do better than a buy and hold, and you never want to compound a loss. And that's, going back to Warren Buffett, the first rule of investing, don't lose any money. Rule 2, see rule number 1. So you've got to be smart about investing. I'm sure anyone that's an accredited investor has experienced losses and learned from that. Maybe still make some, but you're not as emotional about them and you just take the loss, move on, or whatever. So there's a lot to talk about in the resource sector, but I'm going to move on. I talked about cycles here in a little bit. Commodities. There's super cycle in commodities, could be argued one way or the other. I'm not going to make a big deal out of it. What I am going to say is it's essential to the economy, as I said. And what was interesting last year in 2021 is that all of the metals, every single one, tin, iron, aluminum, you name it, copper, every one of those was up in price year over year, except the precious metals. So all base metals, every one of them, lead, zinc, the others I named, all gained in price. And yet gold, silver, platinum, palladium did not, which I find rather unusual. Stocks and bonds, well, why would I put those together when, the common taught thing when I was taught in my finance class, stock investing was all about, bonds balance a portfolio, and stocks are more risky and bonds are safe and all this. Well, the correlation or the disassociation between stocks and bonds no longer exists. They basically move together. And I'm very negative on the bond market and have been for a long time. I'm not very trustworthy of sovereign debt, even that of the United States, which is basically the world financial system. The US dollar is still the financial reserve currency of the entire world. And of course, there are other sovereign nations that issue their own government debt through the bond market. But the US Treasury market is the most deep, vast, and most trusted. The problem being is, as I've said, almost every lecture I've ever given, is that all fiat fails. And the dollar has failed, but not to the level that it's been a problem for anybody right now, really. I mean, with maybe a few exceptions. What I mean by that is, even though the $1913 worth 100 cents is only worth about 2 cents now, there aren't many of you that are listening that are, that age. And you've adjusted either consciously or subconsciously or some combination to the real inflation rate. But bonds do not protect you from the real inflation rate. Yes, I know there's indexed bonds and they give you some protection, but just go back to what I said a minute ago, they don't really use what I would consider to be a truthful measure of inflation. And if they did, then those index bonds would reflect the real inflation rate, and they do not. So I think that both the stock market and the bond market are something to be a little, especially the bond market, hesitant on. Now, if you've got, corporate bonds, municipal bonds, and it's a water bond or it's a utility bond or something that's essential, I'd keep it. Some of those are paying off huge yields, and why rock the boat? That's why I started this lecture, where to put your money in the year 2022, and it is, you don't have to make big changes. You might make some subtle changes. You might shuffle some things around. I didn't put real estate in here. I'm not a big real estate investor. I have just 3 pieces of real estate. They're all nice. I mean, they're, substantive, but nothing like owning an apartment complex or a shopping center, anything like that. It is driven by the debt markets. So you got to be careful on mortgages or the interest rates if you're in real estate, and everyone that is in real estate probably knows a bit more about it than me. I just would say in this period of time, I would be a bit cautious for real estate as well, unless you're really good at it, because we don't know what's going to happen with interest rates. And we also don't know what will happen in certain municipalities, meaning that as things deteriorate in the physical economy, maybe not in the financial markets, there could be restrictions where you're not allowed to increase rents, or you've got to paint the apartment building a certain color because the city fathers say so, and this kind of thing. I'm not trying to be facetious, I am a bit, but the point I think I'm making, and I think you understand it, is there's unknowns to that. Plus, it's very visible wealth, which I'm not against that. It's just, again, as things deteriorate and there's more and more, let's say, itchy fingers to get at what you have, it pays to be discreet. That's my take. ETFs, I'm not going to touch on right now. Trading versus investing. We already talked about, basically, as I said, trading is everyone considers their trading stocks. I mean, very few invest anymore. It's almost impossible in these type of markets. Investing is when you buy Coca-Cola at a certain price low, and then 20, 30, 40 years later, it's higher in price, and it's going up and down and up and down, but the overall trend is considerably up. There aren't many resource stocks that do that, but there are some, and this is what we focused on in the Morgan Report from basically day one. And those are your really your finance companies. They call them royalty companies or streaming companies. But if you look at Franco-Nevada, for an example, which I still hold, one of my largest holdings, and you look at when it was issued at $19, it's been around, and then it was bought by Newmont, and then Newmont spun it back out. And when they spun it back out, it was $19, and it's up. I haven't looked today. It's probably 140 or something. And it pays a dividend. Now, that's an investment. I mean, I don't plan on ever selling that. Occasionally, I'll write options against it. So I'll rent my stock for 3 months or 6 months, and usually I get to keep the premium. And if not, I just buy it back as part of my inventory. Penny stocks is an area I do want to touch on, and I don't think I have a slide on it. But when to invest in resources, basically the when is now. And the reason is, on an inflation-adjusted basis, the mining sector is at an all-time low. I mean, all-time low, like 100-year low. And I don't mean to this minute, but it's within that parameter. And so if you are outside gains in stocks, real estate, bonds, whatever, and you're looking to do better over the next decade, I would highly suggest you consider the resources as probably part of the real economy, that regardless of what the financial markets do as far as returns, that resources will probably give you a real rate of return. In other words, it'll probably outperform, but you got to choose the right one. The ways to invest, the reason I asked Mark at the beginning if this was accredited investors, is there's many ways to invest. And the primary way to invest, of course, is through the public markets, the stock exchange. And the resource sector is a very unusual one from the aspect that there's so many what I call penny dreadfuls or penny stocks in the resource sector. And the reason for that is because it's one of the few areas that you can, I'll say invest or speculate, is a better word, and put in pennies and come out with dollars. However, most of the gold, silver, resource newsletter writers, especially those that have big budgets and are basically publishing houses, don't really do, in my opinion, it's a studied one. I've been in this industry for a long time. They give you a very hypey sales letter about how XYZ mining went from 12 cents to $120. And they've got one now that's probably even better. And all you have to do is sign up and get the report. And sometimes it's free. On those free ones, you got to read the fine print. But I can tell you without reading it what it says that this company was given $1 million and 450 million shares of this stock, and that they're paid to promote it. That's almost always the case. But anyone that's an AI is probably sophisticated enough to know that. My point is that, yes, you can get into that end of the market if you wish to, but if you wish to do it, there's only one way that's been proven over and over again, and that is available for accredited investors only, and that's through what's called private placements. Private placements are when an exploration company, and of course, this is true of other sectors. It's just, again, resources is my specialty, and it happens more in resources than almost any other sector, because there's always someone that's very willing to go out and stake some land somewhere on the planet, file it with the correct jurisdiction, and then hang a shingle out and say, I've made XYZ mining. Here's the shares. It's a public company. And we want the initial investors to participate and usually buy it at a very low price. And this is how your billionaires in the industry became billionaires. It's not because they're a better investor than a well-studied resource sector investor. It's because they had the advantage of buying almost all these companies when they initiated. So the general practice is these stocks come out at 10 cents, they move up to 25, these have a warrant. Then those early investors that are usually the first ones in sell off, their stock at a profit, regardless of the merits of the company. And then that moves up to the first round of financing, which is usually where the accredited investors are into the company. And then it usually goes up from there. So it's no guarantee, but the average is like 60 or 70% of the time, those go up. And you can do the same thing that the big boys did, the initial seed investors, which is sell it off or exercise your warrants and make money regardless of whether or not the company has merit or not. And some won't. In other words, some are so little merit they can't really push it hard enough, or maybe it's good, but they don't get the word out or whatever. I mean, good companies can not do well also. So there's a fine line between rank promotion and pushing it enough for investors to take note of it, and it's that's a tough line to draw. So that is one way to go. I've done it. I don't do it a lot. Most of them that I look at, I'm not really that fond of, but there are some that I am, and I make that available to people that are on the paid version of the website. If you're interested, you can do it. If not, that's fine. I vet them myself. I tell you if I'm going to put my own money into them, and so be it. But that is the best and really only way to get into the penny stock game and do well, or almost, and I can't say guaranteed, and I won't. But you also be smart. I think I'm talking to very sophisticated group, so it's not a one bet, win. You got to use your head, and there's let's say you've got X amount. Let's say you're going to put 100,000 in this sector. So I would divide it into 10. So you have 10,000 per private placement. And so every time one comes available, you put in 10,000. And then if you go out a year or two, what you'll find is 2 or 3 went to zero. 3 or 4 probably went up 200 or 300%. And 1 or 2 probably went up tenfold. So on balance, you've done really well. But if you only put in one and that one happened to go in the tank, then you're going to be really upset. So obviously, I'm saying kind of the basic obvious to everyone that's on this, but I just want to make it clear and maintain my integrity. So cycles we talked about, commodities. There will be, again, food and energy, and I think all the metals, but primarily the precious metals. I'm not sure the base metals, depending, but I think with this contraction that we're having in the economy, the base metals may be neutral. But then if there's, they'd even say the 3-letter word war, then you could look at the base metals having a heyday too. So I think the sector at large, there's ways to invest in commodities in ETFs that are like a basket. You don't have to pick, individuals like lithium and cobalt and aluminum and tin. You can basically buy commodities index. I think that will serve most people well. Plus, you have to worry about it. And when you have a basket, are you going to do as well as if you pick that perfect lithium stock that went from that 12 cents to that $12? No. But again, if you're an AI, you are real, for the most part, unless you got super lucky or won the lottery or something. So that compounded growth rate of 10% or higher is not that easy to achieve over the long term. So stocks, we already talked about. The general market, I guess I will make some more comments about. And I have been concerned about the overall market. Now we have had some, downturn here. I just read one of the stalwarts of the stock market. I won't use his name because he didn't give me permission. And he's saying this is a low and it's just going to keep going up. It's a secular bull market. Basically, the way he made it sound, the way I read it, is like the stock market's never going to quit. And I can make that argument. The way I can make that argument is if the depreciation of the US dollar is strong enough, meaning it weakens rapidly enough, then the stock market has no real reason to come down because you're pricing stocks in a more and more worthless currency. I remember when I really dug in deep and started really going my career path, you might say. And Jim Dimes wrote a book called The Invisible Crash. And in those days, 1,000 was kind of the ceiling for the stock market, believe it or not. I'm that old. But he talked about in The Invisible Crash that if you if you took the major indexes like the S&P or the Dow and adjusted it for inflation, the plot on a graph would not be going up. It would be going down, which means that the invisible crash is what you see on the financial press and what you're witnessing and looking at and seeing this big trend line going up is really not the truth. The truth is on an inflation adjusted basis, you're actually losing money. So I don't know where the dollar is going next week or next month or even next year or this year. What I do know is the trend, and the trend for all fiats is down. And the dollar does better against everybody else for two reasons. It's the reserve currency, so we have no limit basically on how much we can print until basically enough entities say we don't want it anymore. And we don't know how far off that is. And also, it's being printed at a rate as crazy as it is, that's a less of a rate than some other sovereign governments. Take Venezuela, take Turkey, take Argentina, and others that print at a higher rate. So they're depreciating their currencies faster, believe it or not, than the United States is. So relative to that basket of currencies out there, the dollar looks quote unquote good. So you might see the stock market just continue to go up. I'm not going to say it can't, it could, and I think that would be the main reason. If there is some real discipline in the monetary policy of the United States, I mean, real, like these purported interest rate increases were substantive enough where it really shocked the markets, you would probably see the stock market, the bond market adjust substantially. I think you could see them adjust substantially enough where it wouldn't ruin the economy and it would cause some pain. But as the old adage goes, no pain, no gain. I mean, I would rather see that happen and get real and be truthful than to pretend that everything's okay and just inflate the problem away. Because when you inflate the problem away, you destroy the currency. And of course, the banks, I think, are well aware of this, and they have a plan, and that is to put everybody onto some type of central bank digital currency. That's the trend. So I've covered most of these. I've pretty much talked about what I wanted to talk about for the accredited investors. There aren't that many quality companies. 20%, as I said, it's hard to do. I think resource stocks will outperform for the next several years, but we'll see. Could be wrong, I guess. Penny stocks we talked about quite a bit. And I think that's pretty much the end of my presentation. I've got other things I can show you, but are you still seeing my screen, Mark?
Let's see. Yes.
Now you see it in Google?
Yep.
All right. Are there any questions?
We did have a few questions that came in. We had one question. They're wondering, in addition to gold and silver bullions, what are your views on adding platinum bullions to one's physical metal holdings?
I'm going to be writing on that in the next report, and that's not the second report. I like platinum for the first time in a long time. The Platinum Guild, which I am not a member of, but I do get their publications, and I just got one. I haven't read it yet, but I've read the previous one. The platinum metal can be substituted for palladium, regardless of what the pundits on TV tell you. So the automakers will probably switch to platinum in some instances. And that means there'll be a higher demand for platinum and less of a demand for palladium. I like it. I own it. There's very few ways to invest in it. There aren't that many stocks that have it. It comes from South Africa and Russia primarily. Anything geopolitically that happens would probably push the price higher. The spreads are high. I've dealt in the physical platinum market since I was probably 30, 32, something like that. And I've only sold back a couple of times. You will eat it on the spreads. You're going to pay a pretty high premium to buy, and you're going to eat it on the sell. But if you're up, $1,000 on palladium, I did very well on palladium. Going back, he didn't ask about it, but I wrote a white paper for the Morgan Report members that I really like palladium and I didn't like platinum, and I got everybody into palladium that wanted to follow me in, and we did quite well. And then I said, I think it's done enough, and I sold my last tranche of palladium around the 2,300 level. I wouldn't touch palladium at this level. I would go ahead and take a small position in platinum. If platinum starts to shoot up because of, let's say, tensions or power failures or water issues in South Africa, I would take partial profits and look to buy back. So it's always good if you're going to trade around your core position. So for example, let's just say I've got 20,000 worth of platinum and something happens in South Africa and it goes to 30,000. I might sell off a third of my position and book it, but keep the rest. And then if it cools back to where I bought it initially, I'd just buy back more platinum. So that's a good strategy. Pretty simple. What's your next question?
We had someone asking if you had any favorites for 2022 metal ETFs.
I don't. There's slippage in the ETFs, but any of the big ones are pretty safe. I mean, I like PSLV over the SLV, but they're both okay. There's the GDX and the GDXJ, which are the mining indexes and the junior mining indexes. I think you can do well on those as long as you don't really look at them as investments. You look at them as exposure. I would say those are probably 4 to look at. You don't have to get too exotic. There's a double and triple ETFs up and down. Those can make you look like a genius if you happen to time it correctly, but timing on those things is really difficult. I would look at leaps. Look up leaps if you're any AI, I probably know what those are, but I don't even remember the acronym example. Long expiration something. And leaps are available on some of your better stocks like Newmont, Pan American. Now that's where you got a much better chance at an option, especially at these low levels, like I mentioned. We're at like 100-year low on the mining sector. That would be my preference, and that'd be something that you would get as a member of the Morgan Report. We actually put that in, I think, last month or month before to consider some leaps. So I'll say it to this audience. Next question.
All right. Next question here. They say, David, in the past, you've talked about Honey Badger and Envirometal Technologies. What are your current views on these companies?
Honey Badger, I haven't looked at it recently enough. We wanted to do a deal with them on a stream. We haven't kind of given up, and that's not them or us. We just kind of fatigued out on it. So I don't have any thoughts on it at present. As far as environmental goes, right now they're doing a private placement. I am not going to participate. I've overinvested in it myself. It runs hot and cold because it's such a phenomenal possibility, but the stock has done nothing. But if you are an AI and you don't own it, I would definitely get on their website, Envirometal, ENVIROMETAL.com. And since you're accredited investor, you would be able to participate. If you're willing to take a long shot, it's one that could change the industry. And I keep using the word could, not would, because management, in my opinion, and I know Dwayne quite well, just hasn't been able to push this thing, and keep making first downs. The stock's been all over the place, but they do have, it's in better shape than it's ever been. It's selling for the initial offering price. So if you're an AI, I would consider buying some. Don't buy enough to, it's not betting the farm, like I said, but I would get in. I think if this company does go, you'll be able to tell your kids and your grandkids that mining company or that technology to change the mining industry. I bought that in 2022, and that's what's putting you through college or whatever. But of course I can't, I'm giving you my forward thinking, but so there's one. What was the other one? Oh, I just addressed Honey Badger. Okay. What else?
Yep. Looks like we have time for one more here. Viewer asked, do you include pre-1933 gold as part of your physical holdings? And do you see a possible recall or laws against gold and silver?
Yeah, I don't. Some do. Yeah, I have a few just for fun. I happened to meet so many people at the New Orleans conference. I made a pretty good friendship with one of the numismatic type guys, and he gives me good deals, but I buy them pretty close to bullion prices. But if you love coin collecting, that's another thing. I don't. I just don't have the time for it. But I do not buy into the confiscation argument. I've argued against it. But if you believe it and it makes you comfortable and you want to do it, that's fine with me. Personally, I don't see a problem. If you just go to the bullion coins, silver eagles and gold eagles, it'd be against the law for the federal government to take those. So if you're worried about it and you want to stay in bullion only, stay in those. There's no way. I mean, someone that wants to nationalize U.S. gold coming out of the U.S. Mint would have a pretty big lawsuit. So I don't think you'd have to worry.
All right. Well, David, thank you so much for that fantastic presentation today and taking the time out to address our audience. Thanks again. Always a pleasure hearing you.
Thank you, Mark.